What is a share buyback and should you avoid investing in companies that often buy back their shares? Hi, I'm Henrik, and in this video I'll shortly introduce you to share buyback programs and will share my ideas if it is worth investing in those companies or not. Definitely there are companies that do well buying back their own shares, and oppositely there are companies that damage their business buying back their own shares. Today we'll go over those elements to identify if a company is doing well or not. Just make sure you subscribe to this channel if you want to expand your investing skills, and also if you prefer to see subtitles, they are available. Okay, let's start. Firstly, let's shortly understand what a share buyback program is. It is when a company buys its own shares, and when they buy them, the X amount of shares are cancelled. Like if a company has 5 shares, each share represents a 20% portion of the company, and the company buys 1 share back, that means 1 share is cancelled. And after that, there are only 4 shares outstanding for 100% of the company. And each of those 4 shares automatically becomes more valuable as each share has a bigger proportion of the company after the share buyback program is executed. Each share represents a 25% portion of the company. So the main point is that shares become more valuable as a portion of a company, but the company's equity decreases as they spend money to buy that shares in the market. So the company becomes smaller. So every coin has 2 sides. When particular shares are cancelled, the shareholders own a bigger proportion of something that now has less value than before the share buyback program was executed. So the question is, which one is more valuable? To have a small portion of something big, or to have a bigger portion of something smaller? So to identify if a company is doing well or not buying back their own shares, we must focus on 2 main things: the ability and profitability. Let's start with the ability. The main question here is if the company has enough ability to spend that much cash and has enough liquidity and a healthy balance sheet to afford the share buyback. To know the answers to those questions, you must look at the balance sheet. If the company has loads of debt, or has a low current ratio, or has limited cash but still runs a share buyback program, that's a big red flag for a company. Ideally, a company should do a share buyback program when it has a healthy balance sheet, meaning a lot of cash, low debt to equity ratio or no debt, and must have a current ratio above 1. And even in those cases, companies think it is better to spend their money investing in new ideas than share buybacks. So if they don't know where to invest their money and they don't want the money to sleep on their balance, only then it's a good idea to run a share buyback program, because it's just another way of paying investors like dividends. But that's good only when they have enough cash for a rainy day and they don't know what to do with the extra liquidity. Only having cheap financing shouldn't refer to a share buyback program. You may be surprised why a company should start a share buyback program if they don't have a healthy balance sheet. There are many reasons for it. I will name a few important ones. The reason A, they do it because it's fashionable and they want to show that everything is okay in the company. Reason B, the management or the CEO has stock options as compensation and they will personally benefit financially from the rising stock price. Reason C, they want to boost the per share data to show a growing company to attract new investors. Reason D, the management is stupid. That's it. So you must run away from those companies that don't know what they are doing, or they act without taking care of the company or the shareholders in the long run. Unfortunately, there are many companies that use every ounce of their balance sheet to buy back their shares at times when they shouldn't do that. We had a typical example in the airline industry when CEOs borrowed a lot of money to buy back their shares while having many problems in the balance sheet. They boosted the stock prices, but the businesses got a lot of problems in the future. So when the economic shutdown started, they only needed the government to bail out them because their current ratio metric was less than 0.5 and they couldn't cover their payables as they didn't have enough liquidity. But only a few months sooner they were running share buyback programs to boost the share price. And that's why later the government was against share buyback programs for the companies they bail out. They just don't want the idiots to damage the businesses further. And oppositely, we have many good examples like Apple, Facebook, and other many companies that really do well by buying their own shares. They have enough excess cash and healthy businesses to afford themselves a share buyback program. By the way, smash that like button if you are getting value. That will help our channel to be ranked higher so that we can make more valuable videos for you. Okay, let's say a company we want to invest in has a healthy balance sheet and runs a share buyback program. But that's still not enough to judge if the company is doing well or not. We must understand the second important part of this process, which is the profitability. So the main question we must focus on is if the company is doing a profitable deal by buying back their shares. Are shares trading cheap in the market, or is the company overpaying for those shares? If the company is overpaying for the shares, then it's not talking good about the management. And if shares are trading cheaper than its true intrinsic value, then the company is really doing well buying back their own shares, as a stock buyback is a typical investment. As Warren Buffett explains, there is no big difference if you invest in buying your own shares or another company's shares. If you are paying less than what it's worth, then you are making a good investment. And oppositely, if you are overpaying, then you are doing it wrongly. Another thing Warren Buffett said is that if a company finds its stock selling below its true intrinsic value, then they will make a big mistake if they don't buy back their own shares. To understand if the shares are being sold in the market cheaper than its true intrinsic value, we must first value the share price ourselves. To learn how to value a stock, how to find the true intrinsic value of a company, attention please. You just need to click on the card here to watch my video where I explain it in detail. And if you want to learn even more about investing, make sure you subscribe not to miss my upcoming videos. Now you better watch my next video about Warren Buffett's investment strategy by clicking on this video. And leave your comments below about your thoughts if a share buyback is a good idea or not. Thanks for watching. Watch the next video.